Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be the co-host today. And I'm really excited to have Lonnie Hendry with us. Lonnie is the Chief Product Officer at Trepp. He's the co-host of TreppWire Podcast, and he has been involved in all things real estate related for the last 20 plus years. In fact, he's even teaching at Texas Tech as well. So Lonnie, welcome to the show. Super excited to have you here.
Thank you for having me on. Looking forward to the discussion and big fan of the show. So thank you for letting me be a guest.
Yeah. Thanks so much, Lonnie. So it's, I've been listening to Lonnie and his co-host podcast now for probably 9 months or so. And it's been something that's really helped me grow in my education in the space. So I wanted to expose our listeners to this one as well, because it's been a really nice addition to my education journey. So Lonnie, if you can you tell the audience a little bit more about yourself than just the couple of bullet points that I shared, so they'll know, like I do, that we're talking with a true expert in the space?
Sure. Yeah. So I appreciate the opportunity. So I spent 22 years or so in the commercial real estate space, pretty much done a lot of different activities. Started off in multifamily property management and development, worked for a local developer. We bought land, we got it entitled, we built apartments, we leased them up, we sold them, we moved on to the next project, managed some high-end Class A properties, and did some low-income housing tax credit Section 8 stuff. So I had some really great practitioner boots on the ground experience with the whole development process, property management process. I was 19 or so when I started in that business and got hooked on commercial real estate, got my real estate license, brokerage license, been transacting on properties for the last 15, 20 years. Got into teaching, did some valuation work, and now I work at Trepp as the Chief Product Officer, where it's really great. I get to work with practitioners that are doing deals every day or trying to use data to help enhance their business process. And my experience and background as a practitioner, but now at a company where we deliver data products and services to the market, really makes for a really great combination where I speak the language, I understand the nuances, and then the academic stuff at Texas Tech is just kind of my way to give back to younger, folks in the CRE space that are wanting to start a career. Like I wouldn't be where I am or have had the opportunities I've had if I didn't have people plug into me that were a little more experienced. And so I live, eat, breathe, sleep commercial real estate 24/7. It's all I do, and I love it.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Love it. So that's a mouthful. I'm wondering if you could jump a little bit into the education piece that you're in. You mentioned that you're involved with teaching folks about how technology and commercial real estate are intertwined. Can you share a little bit more about that?
Yeah, so last year at Texas Tech, we decided we were going to start offering a course, a property technology class, because in my day job at Trepp as the Chief Product Officer, as I mentioned, I'm working very closely with market participants, and I'm seeing real time how real estate investing, real estate ownership, real estate development, all of those things are having a more and more reliance on technology to help increase their speed of delivery, understand the nuances around their vacancy, understand what market rents are, what cap rates are. Technology plays an increasingly more responsible role in their decision making. And so we thought for the students, it'd be great. These are finance students that have a concentration in real estate. Why don't we marry the core financial components of modeling and underwriting deals and discounted cash flow analysis with this concept of how technology is implemented in real estate? And so what we've done is join the two together and created a course that allows our students to come out of college with an understanding of how to create some Python scripts, with an understanding of how to use technology and data in ways that you might not generally get in a traditional college curriculum. And we think it really sets our graduates apart where they can hit the ground running, because what we know is the best operators are using data to make decisions. They're not making decisions subjectively. They're making decisions based on data. And if our students can pull better data, you can make better decisions, and better decisions usually lead to better outcomes.
Outstanding. So, being a student of commercial real estate yourself, I suspect that you've seen a lot of evolution over the years in the technology that's available for, ultimately selecting the right assets to invest in. Can you talk to maybe some of the milestones that maybe we've seen during your career that have really helped to speed up that due diligence process or the selection process of finding assets?
Yeah, it's amazing how much data is available on the market through public sources if you just know where to look. So,
Sure.
simple searches on county assessor websites of identifying the last time a property sold, what's the ownership entity that actually holds title to the property, doing some searches on the county clerk's website to find the deed records, looking on the Secretary of State's website to see what is that entity and who does it tie back to. So you can actually start building up a profile of who owns the property. You can see what the latest transaction was. There's a lot of other information, like the advent of APIs, where you can connect system to system and start pulling data in, has really revolutionized consumers' ability to be informed about a particular property or particular market. So things like traffic count, Uber pickups, Yelp reviews, all of these things that traditionally have not been considered commercial real estate data points necessarily.
Yeah.
With the tools and the systems that are available now, you can bring all that in and you can become much more informed around what are the drivers of value in a particular market or for a particular asset. So there's no shortage of availability of data. There's no shortage of insights if you just know where to look. And a lot of this stuff is available, at a marginal cost for people that just want to take the time to learn where to look.
I love it. Yeah, it seems like a lot of the more powerful tools that are available, the CoStars of the world, are very expensive and hard for some of the smaller operators to potentially pony up for those dollars. So it's good to hear that there's some public offering or some public data that's available out there that are available for those folks. So not everybody is a billion, 2 billion, 5 billion AUM organization that has the resources to invest into those type of tools. So now, I know when we were getting ready for the podcast, you mentioned that you were actually an active broker as well. So you have been like literally on the front lines looking at transactions for essentially decades. So can you give the audience a sense of where we're at in the market? We all know that the last few years have been relatively tough, but curious what you're seeing today.
Yeah, I think it's important to understand that real estate by definition is cyclical. For a lot of investors today, they had only seen the upward trajectory of a cycle. So coming out of the great financial crisis in 2008, starting around 2011 or 2012, things really started picking back up. And up until 2020, we'd only seen values go up, cap rates come down, everyone was making money, and it felt like a really great thing. The reality is, as I said, the market's cyclical. So like right now, we're in a little bit of the downshift where things are resetting, and it's not unpredictable. It's not something that should shock anyone. Like it's a reality of the market. Things get a little overheated, things cool down. So like from an academic perspective, the market goes through a cycle we would call growth, equilibrium, decline, and then revitalization. We're past the equilibrium, probably in a decline in most markets and most asset classes, but that actually allows for buying opportunities. When distressed assets come available, by practice, you're getting those deals at a discount. And those discounts generally translate in the ability for the owner to invest capital to, if it's an office, improve the lobby, or multifamily to improve the kitchen and the bathrooms, or whatever the case may be, to try to drive increased value for the property. So it's a necessary part of the cycle. I think right now we're on the early end of the distress cycle. I think we're still very much in the headline phase of distress. We haven't actually seen actual distress play itself out, but that'll happen. And it's unfortunate for those that have investments or for those that are part of those transactions, but it's just part of the cycle. So for people that are in the market, this is definitely a risky endeavor at some level because there's no guarantee. The market's dynamic. It changes every day. Some events are bigger than the property. Some events are bigger than the operator that they can't control. But if you use data to make decisions and you're conservative in how you approach things, you can try to mitigate those challenges. And right now, we're still early in the cycle. I think there'll be more distress, but I think the distress creates opportunity.
Absolutely. Yeah. And I'm wondering, Lonnie, I've been talking with a lot of folks about, and I think I actually heard on your podcast, how there's this transition that goes from distressed seller that turns into a distressed property, which then becomes like the true opportunity. Can you talk about that process maybe in a little bit more detail? I've tried to share that, but I think you can probably do that much more eloquently than I can.
Sure. Well, I don't know about that, but I'll try. So
Sure.
a distressed seller, is someone that actually owns the property. They have a mortgage on it and they're under duress or distress, right? So they can't make the mortgage, or they're having trouble getting a refinance at maturity, or there's something that's causing distress for the property.
Yeah.
Now, the borrower has a fiduciary obligation to their investors and to themselves to try to exhaust all remedies to rectify that situation, to get the building back to being viable, to making sure it's current on the mortgage, et cetera. The lender has the same exact fiduciary obligations to their shareholders, where they're going to do everything they can to make sure that they don't take back a building that they can't sell minimally for the loan balance.
Yep.
So on the first part of this distress is you have the distressed seller that effectively is doing everything they can to become a non-distressed seller. And if and only if they've exhausted all remedies and there's no other option, then the bank steps in and it becomes a distressed asset. Once it's a distressed asset, as we know, banks are in the business of lending money, not operating assets. And so they don't want to own an asset. It's a liability on their books and they try to offload it. That's where the
Yep.
buying opportunity comes in. If distressed borrower, distressed owner is going to fight till the very end to try to keep the property because they either want to preserve their equity, they want to keep their good name, whatever the case may be. When the lender steps in, the dynamic shifts. At that point, they need to proactively get that liability off their books. And that creates buying opportunity for informed buyers that can come in. You're going to buy those properties with some inherent risk. You're not going to get the full due diligence. You're not going to get full access. There's usually generally something that's causing the distress. It's usually not just the owner or themselves. Sometimes it is, but generally not. So you're buying a property subject to all of those challenges that already exist. That's where you have to get a discount. There has to be some acknowledgement of those inherent risks, and the acknowledgement of those risks is generally in the form of a reduced buying price. So if a property sold last time for 100 million, you're not going to pay 100 million for that same distressed asset. In most cases, it's going to need to be at some discount so that you have some protection on the upside.
Yeah. No, thank you for walking through that. It's been, you hear distress from different levels of that. And a distressed opportunity is not always a great opportunity for the passive investor because there's going to be some ups and downs throughout getting that asset out of the distress. And I had a project that we did earlier this year that we had took over from an operator that was in significant distress. They had lost a number of different assets. And I think we were at 90% occupancy, 92% occupancy when we took over. And over the last 4 or 5 months, it's dropped down to almost actually sub 50% occupancy because they just loaded it up with a bunch of bad tenants that, in hindsight, we have the capitalization to renovate the units and then bring it back up to par. But 50% occupancy is a scary sight when you're seeing that as a passive investor. I'm curious, in those types of situations, how difficult is it for an operator to turn an asset around that might be taking over a highly distressed property that maybe the fundamentals and the structure, and the core major, the HVACs and the plumbing and all of that looks good. Like, how difficult is that for them to turn it around? And is it likely to turn around with an operator?
Yeah, so I think it's a great question, and it's a difficult one to answer in a broad fashion just because
Sure.
every asset is unique and every market is unique. And I think broadly, we sometimes fall into this trap of like national narratives or national headlines. And what we know is that real estate is a local and sometimes hyper-local endeavor. Two properties on the same street could have some completely different outcomes.
Yeah.
And it's not just the operator that drives those outcomes. Sometimes it's what was the debt load when they took the property over. To your point, it's something I'll take a few seconds to kind of delve into. The oldest trick in the book, right, when you're selling a property that's distressed is to try to get the occupancy, the physical occupancy, as high as possible. So they'll say, this property is 92% occupied. Well, there's two components to that. You have the physical occupancy or likewise the physical vacancy, but then you also have the economic occupancy or the economic vacancy. So like the way this would work is you could have a space that on the rent roll shows to be occupied. So let's just say an example, you have a warehouse, there's 10,000 square feet subdivided into two 5,000 square foot bays. You could have, it's very simple. If you only have one side physically occupied and the other side's vacant, you say this is 50% occupied. Super easy. Everyone understands that. But you could say, we're going to have someone move into the vacant space, but we're going to give them 1 month free. So in that example, the property is 100% physically occupied, but the best the landlord can do in that instance is only collect 11 of the 12 months of rent. So you've created an economic vacancy of about 8.3%. Now, just do that times however many months free you get. For every month, you're adding 8% economic vacancy, even though the rent roll shows physical occupancy at 100% or 90% or whatever. So in the due diligence process, it's super important to understand, I get it that the physical occupancy is 90, but how much rent are we collecting relative to what we're billing? If we're only collecting 70% of what we're billing, that economic vacancy is very high, and that's very difficult to rectify, because at that point you have a tenant that's physically occupying the space that's not paying. It doesn't matter how good of an operator you are, it's difficult to go through the eviction process to get them out of the unit. Sometimes you have to pay to get them out. Like, that creates a headache. So I'd say before we even get into like the value add part, just having a full understanding of, when we reference 90% occupancy, is that just physical occupancy or is that the economic occupancy? If it's not the economic, first question I want to know is, what is the economic occupancy? Because that's going to give me a really good indication of where we're actually at from a financial perspective. And then just to your question around turning it around or getting an operator in there, operators are like anything else in life. You could have two doctors that went to medical school and they both got a degree and they're both licensed medical doctors, but it doesn't mean that they're the equivalent in terms of their skill or in terms of how good they are at their job. And the same thing holds true here in commercial real estate. You can have a lot of people that have bought and sold assets, they've been in the market, they understand, but that doesn't mean by definition they're going to be a great operator. And so you have to know, like, what's driving the distress. Is it poor management? If that's the case, then yes, someone can come in and reasonably quickly turn it around. If it's poor management, sometimes it just is poor management, lack of experience, lack of understanding, lack of relationship, whatever. But if those things are decent and it's something external to the property, if it's physical challenges, if it's road construction, if it's other issues, zoning, other things that have changed over the ownership's period of ownership, and now new owners coming in, they're not going to be able to change those factors, just like the previous owner wasn't. So it's hard to paint a broad brush. I would say, like, in the due diligence process, you want to ask the questions like, why is this property struggling? If you can't quantify that, it's going to be very hard to have confidence that they're going to be able to turn it around. If you can quantify it to higher expenses than what the market suggests, lower rental rates or higher vacancy due to mismanagement, those are things you can fix. If it's something external to the property that's bigger than the individual property or the ownership group, it's going to be very difficult for anyone to turn those around.
Yeah, it's, and I'm always trying to look at this from a due diligence standpoint, from a passive investor. And, most operators will say that it was managed poorly. Like, that's the easy answer to say. They're going to swoop in, they're amazing managers, and they're going to be able to fix all the management issues that were in place. But I'm trying to figure out, like, how do you dig deeper than that? I hear people talk about this lease audit process. So if you're looking at economic vacancy, can you literally dig down to the paperwork to take a look at the quality of the tenants and uncover what truly is at the core of the problem? Or is that something that you hear people throw around and it's not really happening during due diligence?
I mean, I think it's like anything else in life. You have some passive investors that just take things at face value, and for them, maybe it's worked out, or maybe they've had some bad experiences and they learn from that. I would just ask the hard questions. I mean, obviously people are going to tell you and create a narrative based on what they're trying to achieve. Like, what is their objective? If the objective is to acquire the property and raise some capital, they're going to do everything to highlight the benefits and the upside and everything else. And those all may be 100% true. And listen, I think there are more good operators than there are bad operators, right? I think there are people that are trying to make a living for themselves, buying properties, syndicating deals, raising capital, going through the process. But it's not without challenges. And this business is a very highly competitive business with very smart people. Most properties have multiple companies looking to acquire the property if and when it comes on market, or even if it's off market. So due diligence from a passive investor perspective is very important. Like, you need to ask the tough questions. I want to see a copy of the trailing 12 months. I want to know what the line item expense breakdown is. I need to have some understanding of how do those expenses compare to the broader market of a competitive set. Is there a track record of this type of acquisition where there's a value add component? And did you successfully execute on that? If the answer is yes, that's great. But then I want to follow up and say, well, when was that? Because if it was when interest rates were going down and cap rates were going down and values by definition were then increasing, a lot of people did really well there. Like, have you done something similar to this in a similar type of environment with similar challenges? And if I can't get a good answer to those things, then it probably gives me a little cause for concern.
Yeah, I've really been trying to dig into when I'm looking at track record and seeing all these very, very hefty equity multiples with operators, like digging into actual NOI growth during their hold periods versus just cap rate compression growth that we saw or value that was created. And what I'm finding is operators aren't always very eager to show kind of the negative of that. Like, it's really easy to present, 30% IRRs, but like, let's dig into that and see actually what caused those IRRs to be. So I'm curious, are there questions or analysis that a passive investor can do to kind of dig beyond just the PowerPoint presentation to dig into that deeper?
Yeah, I think it's on the equity multiple side. Was all of that return on reversion? So like, they bought the property, cap rates went down, values went up, and there was no incremental cash flow growth over the hold period. Did they get the return on the reversion? If that's the case, and this is a value add discussion, then I probably want to dig a little bit deeper in that. I think as a passive investor, there are a couple of things that you should take upon yourself to get educated on, right? Like, you should learn how to read an operating statement. So if you don't know what potential gross rent is, or you don't know what other income is, or you don't know how to articulate what the difference between an operating expense and a capital expenditure is, you should probably take some time and learn about those things. If someone's just talking to you about multiples or IRR or something else that's hard to understand and hard to define and can be manipulated, you should have a better understanding of just the foundational elements. Like right now, rent growth is a hot topic. So like, we saw deals from 2019 to 2021 on these value add reposition plays where people were literally underwriting 10 to 12% annual rent growth on multifamily. Right. Well, one, that's very unlikely to happen. Two, even if the rent grows 10 or 12%, that doesn't mean that it's going to flow down and you're going to have a 12% NOI growth. And expense creep is very real. And the reality is, it costs more to operate a property today than it did 3 years ago. So if someone's coming in and they're saying we're going to cut expenses by 12%, I want to know where they're going to get that savings from, because taxes, insurance, personnel costs, repairs and maintenance, those things are all up. Inflation has impacted those negatively. So a 6% rent growth may equate to a 0% NOI growth or a 2% NOI growth because of the expense growth that's happened. So those are just some things in the diligence process where you can't make a decision just off of a spreadsheet. You can't make a decision just off of a PowerPoint. You have to understand the nuance that goes into it. Real estate, especially on the valuation side, and looking at equity multiples, and then cash out on stabilization and refi. Like, all those things happen, and there's a ton of people that have success stories. But at the end of the day, the NOI is what determines the value. You got an NOI and a cap rate, whether you do a discounted cash flow and a reversion, or you do a single year direct cap valuation. What is my NOI? What is my projected NOI growth? Do I think that's reasonable? Do I think that can be supported by market-driven data? If the answer is yes, good. If the answer is no, I'm probably hitting the pause button and asking a few more questions. And if they don't want to show that, obviously, that's another indicator that it may not be the investment for you.
Yeah, I found recently, over the last, 6 to 9 months or so, I've started asking new operators to provide their most recent investor updates that they've sent, whether it's monthly or quarterly, and making sure that aligns with what they've shared during the due diligence process. And surprisingly, they don't always match. And even more surprisingly, they don't always want to provide those, which is an immediate red flag for me that I step away from. So, Will, I know it's not all doom and gloom. Like, you guys use the term green shoots and crabgrass. So can we talk about some positive news, some positive things that are going on in the space? What is your outlook for the coming months and years?
Yeah, so I appreciate that, because I think the doom and gloom narrative gets too much headline space, and the reality is If you look at the delinquency, we put out a delinquency report every single month. So this last month, our overall delinquency rate is just over 5%. Office is the worst category. It's like 7.99% or 7.97%.
Yeah.
So in the worst of worst, like we're saying, office is, almost an untouchable asset right now. No lender wants to make a loan on them. Nobody wants to go work in them, et cetera, et cetera. Delinquency for that asset class is still less than 8%, which means 92% plus of the properties are making their mortgage payment. So amidst all of this headline gloom, the reality is most properties are performing just fine. Most operators are still paying the mortgage on time. Most assets are still, maintaining value, or some asset classes are still growing in value. So I would suggest, like, don't make decisions based on what the headlines say. Try to get into your local market and understand the nuances of those fundamentals. And I think in doing that, you'll see there's a lot more green shoots than there is crabgrass, even though the crabgrass right now is getting the headlines because offices forever have been a very safe investment. You've seen a lot of institutional capital flow into urban offices, and lately maybe some suburban office, where people loved having office investments. They were 95% occupied in the urban cores. They were occupied by accredited tenants. It was a really great investment. And we just had this huge behavioral shift where people don't go to the office anymore, at least at the scale that they used to. And so that asset class is in a little bit of disarray. But even in the worst of worst right now, I think the distress will get above 8%, but supposing it's at 8% today, 92% of the mortgages are still paying. So I think from that perspective, there's a lot of really good activity in our business where we track the CMBS market. Just to give some perspective, in 2023 year to date, so January through September, there's about $26 billion worth of CMBS issuance. If you look at what's been done today in 2024, January to September, which we're not even through the full month, there's 72.12 billion of issuance. So it's some multiple more than what it was last year. And we haven't seen the Fed cut rates. We haven't seen anything really to stimulate the marketplace. This has really just been organic issuance growth. If we get a favorable, cut from the Fed here in September and we stimulate the market a little bit, you're going to see that be even stronger in the fourth quarter. So I think this narrative of dry powder on the sidelines, wait till we hit the bottom, like, I don't believe in the bottom. Like, I think the reality is the market just ebbs and flows every day. There's opportunities in up markets. There's opportunities in down markets. So if you're an investor out there, find some properties that have good upside, that have good, strong fundamentals, that the operator can show you their track record, show you why they think their value thesis will play out with data. And if they can do that, there's plenty of opportunities out there.
And we've already seen some pretty big players make some big moves on large transactions over the last 60 days or so. So that tells me that if the big money sitting on the sidelines is starting to move, or at least hinting at moving, then now maybe we're not completely at the bottom, but it should be rounding back up here shortly. And all things are pointing in that direction from what I've seen. So
yeah, I mean, I think notwithstanding some global challenge or geopolitical trouble or whatever, the market seems to be bouncing back. And it's just an interesting dynamic where you would have some people that would say those really big players, they kind of create the narrative around the market. So they're hoping by deploying those large capital stores and buying large REITs or buying large multifamily assets or whatever, they're trying to stimulate and be a catalyst for the market. And I think there's some truth to that. If you're a large enough player, you actually have the ability to kind of move the needle a little bit with your activity, right? So they talk their book and then they go out and place some capital, hoping that others kind of follow them into the market. But I do think with the Fed saying in December of last year, like, hey, we're done with the rate hike cycle. We're setting ourselves up for some rate cuts now. We're going into an election cycle. Once that's all settled, once the rate cuts come in, I think you're going to see a lot of stabilization. Real estate can work in high interest rate markets. It's not like we've never had an era of high interest rate. In the 80s, interest rates were significantly higher than they are now. Commercial property still traded, transactions still happen. Where the markets really slow down is when there's a bunch of uncertainty. And I think we're past that part. I think now we've stabilized at kind of a historical norm for rates, and they're going to come down a little bit with Fed action. And I think you'll see a strong fourth quarter. And I think 25 is setting up to be a really good year for CRE. I mean, the one positive takeaway for the market broadly is just that even with all the distress, you look at COVID, you look at them shutting down everything, hotels going to zero occupancy overnight. You look at the office and the paradigm shift there. On the whole, loan losses, investors being completely wiped out, is still a very, very small percentage of the overall ecosystem of CRE. So it's proven itself to be a reliable investment. It's proven itself to be a resilient investment class. And I think that you'll continue to see that type of trajectory for commercial real estate over the next 10, 15, 20, 50 years. Like I'm all CRE all day, every day. Like you're going to be hard pressed to help me understand how and why people would go away from commercial real estate.
Sure.
I think for the passive folks, though, it's imperative, especially given where we're at in the cycle, that you ask the right questions, you dig a little bit deeper, you try to make folks that are going to take your money a little bit uncomfortable, and you see how their reaction is. Because right now, that's where we are. A lot of people are uncomfortable. The rent growth that they underwrote's not there. The expenses that they hope to cut didn't get cut. And it doesn't mean that they're bad operators. Like I know you mentioned, Randy, like some of their investor updates maybe didn't match what the presentation said when they were raising the capital. That by itself, to me, the market is dynamic. Like you have to understand that as a passive investor. Like that's their pro forma. That's their best guess. So it's not a guess, but that's what their best synopsis of activity is going to be on the front end of the deal. It doesn't mean that it always plays out that way. But what I would say is that they stop
let me clarify if I could though as well. Like I wasn't saying investor reports matching the pro forma, investor reports matching what they were verbally sharing with me. So I understand obviously
that
performance
is
just
a red
performance.
flag for sure.
Yeah.
If it doesn't match what they say in all instances, not good. But yeah, I think you have to understand as an investor, just because the performance isn't what they had anticipated doesn't mean that they're a bad operator. It may mean that we're just in a tough part of the cycle. And again, it's just where you have your comfort level, your risk tolerance as an investor, et cetera. I mean, all investment has risk regardless of whether you're buying a stock, a mutual fund, real estate, whatever. There's some inherent risk, and you got to just find where your threshold is.
Okay. I'm curious what your thought is. Just one more question, and then we can move towards wrapping this up. But I'm curious about your thoughts, where some of these operators that did very, very heavy acquisitions during 2021, 22, that they're struggling. DSCRs are sub 1.0. Maybe we're starting to see some challenges with occupancy just because of the natural market trends. What are your thoughts about how those investments, those projects, how they could potentially impact new deals that are going to market today? So, if half their portfolio is sub 1.0, but the rest is blown it out of the park, how confident are you that they're going to be able to perform on new assets when they've got the drag of these others potentially?
Yeah, I mean, I think it's a fair question, and I think it's one that goes into having a deeper understanding of the portfolio composition. What is dragging those properties that are not performing down? Did they make some aggressive assumptions that they shouldn't have made? Did they take on, debt that they shouldn't have taken on? Did they use floating rate debt, not buy the appropriate rate caps to protect themselves and their investors? Like, were there decisions made that an operator shouldn't make that put them in this position? If that's the case, that's problematic. If they did all those things right, if they took on a conservative amount of leverage, if they bought the rate caps, if they did everything that a reasonable, prudent investor would do, and there were just some external characteristics around the property that they didn't fully understand, or the Planning and Zoning Commission is playing hardball with some of their permits for the renovation, or if there's supply chain issues, or there's things that have happened that impacted the property negatively, that gives you a little different perspective on it. And then if they have half their portfolio that's a positive track record, I want to ask the same questions. Like, did these assets turn positive because of their operational abilities, or did they just get the tailwinds from the market? And so I think, and just to give some context for that. So I know in multifamily in particular, there's been a lot of talk around some syndicators and people that bought in 19, 20, 21 that are underwater right now. And there's a couple of things that I think prudent passive investors could ask going forward. If they're taking out floating rate debt, right, which means that the rate on the interest rate on the loan can reset. Let's talk about that. Like, I need to understand why we're using a floating rate loan versus locking in a fixed rate loan over the term. There may be justification for doing that, but I want to understand what the downside risk is. Do we have the appropriate rate caps in place? What's the worst case scenario if we have to extend this into an extension option period? Is there an administrative fee? Do we have to buy a new rate cap? Like, Those are things that I want to have a clear understanding of before I write a check to somebody. If they check all the boxes and they give you a good answer on that, then I think that's fine. But what's happened is from 20, over just over the last 5 years, in the short-term bridge financing marketplace, we've had about $150 billion worth of lending activity. Most of that was floating rate, 24 to 36 month loan term on the initial loan takeout with 1, 2, or 3 12-month extension options. The challenge with that is if you bought a property in 19, 20, or 21, in 2023, in the first half of 24, 1.1 million new apartment units were delivered from a construction pipeline. So your value add reposition of your 1970s Class C property is now competing with a bunch of new Class A stuff that's on the market in a soft market where they're dropping their rents. And the rent that you thought you were going to achieve is probably not achievable. The floating rate nature of that is problematic. They locked in a rate at origination at 2%. Now with the floating rate and the adjustments, if they don't have a rate cap, they might be paying 11% interest. That is going to eliminate any free cash flow you have on the property. But just to give some perspective, 150 billion, 70% of that's been multifamily, and less than 20% of that 70% is in this distress bucket, right? So it's not an inconsequential number, but relative to the overall multifamily space, it's just a rounding error. And so I would just suggest to people, like, don't buy into the hype. Sure, in the Sunbelt states, there's been a lot of activity, a lot of inexperienced investors that came in. There's going to be some distress. But like we talked about on the front end of the show, for the people coming in today with new capital, there's going to be some really great buying opportunities for some of those properties.
Thank you for kind of bringing that full circle. And that really talks to the message that I've been sharing with investors as well, as there are some amazing opportunities that are either here in front of us or on the horizon. And now I think is a good time to get some capital at work. I think personally, I'm a fan of the dollar cost averaging, placing small checks in multiple markets, multiple asset classes, multiple operators and deals consistently year after year after year after year. And if you do that, you're going to have up and down years, but as a whole, commercial real estate, specifically multifamily, I believe is going to outperform anything that you can see in any of the other markets. So, well, Lonnie, this has been a lot of fun. You bring a new perspective. I felt I was a little bit over my skis by asking you to come onto the show, but the ultimate goal is that I'm trying to help educate the passive investor, and certainly wanted them to get to experience what I get to experience with you guys every week. So maybe if you could, Lonnie, can you tell the audience again what you guys are doing at Trepp, what you guys are doing with TreppWire as well?
Yeah, the opportunity. So Trepp, by definition, we're a data modeling and analytics firm. We track the commercial mortgage-backed security, the CRE, CLO, and the Fannie Freddie agency markets. We're written into the reporting structure. We get owner-submitted income and expense financial statements submitted to us directly from the servicer, and then we build really great products, analytics, insights, and research on top of that data. So we have a lot of free data. If you're someone that's just looking for some newsletters or some market commentary, go to our website. It's just trepp.com. You can sign up for our newsletters. We have a daily newsletter called The Rundown, where we track the transaction market. We give you a big picture story every morning that comes out every Monday through Friday. For the products and services, we have a bunch of different subscription options. Love to talk to you about that if you're interested. And then on the TreppWire podcast, we're 278 episodes in. We have over 1.5 million listens. We do a weekly show on Thursday. We've never missed a week since March of 2020. And we spend 45 minutes to an hour just kind of recapping the events of that week from a CRE perspective. So if you haven't listened to us, we'd love to have you check us out. We try to be educational. We try to be, as funny as a couple of nerdy guys and Haley can be. But we have a really great rapport. We love what we do. We live in the data. And so we try to keep the subjectivity out of it and really just bring some data-driven, market insights week to week.
Love it. Love it. Yeah. And what I like probably more than anything, one is the fun banter that you guys have going back and forth. So that's great. But two, you guys actually list specific transactions that are occurring in various asset classes all over the country. And we get to hear a lot about WeWork and many other big things that are common in this space. But it's been a really nice addition to my weekly listening. And I feel like I just learned a ton from you guys. So Lonnie, thank you so much for being on the show. I do have a few questions I'd like to ask everybody before we wrap up, if you've got just a couple of minutes still.
Sure. Yeah.
Okay. So we talked a lot about due diligence on this one, and I thought you gave some really good advice there, but I'm curious, are there one or two or a handful of due diligence questions that you think passive investors should be asking that they seem to not be asking during their vetting process?
I think one thing that you can do, and you might get some pushback from some of the operators, is have them connect you with some of the other passive investors in their other deals.
Okay.
To get some perspective on how they think the deal's gone, right? It's one thing for the person that controls the narrative to kind of give you their spin on how things have gone, good or bad.
Yeah.
It's really interesting. It'd be interesting to kind of see how other passive investors feel about those same deals, right? So if you can get access to somebody that's already invested with the operator, I think that's a really great way to kind of get some insight into that. I think looking at the P&L or the operating statement and getting a familiarity with the asset is important. It's one thing to look at projections. It's one thing to look at, underwritten assumptions. It's hard to argue with what's taken place already. And if you can see what's happened over the last 12 months, it gives you a little bit of better basis relative to how realistic do you think those assumptions are on the go forward. I mean, like, I can't predict what's going to happen 5 minutes from now, let alone 5 years from now. So I
Right.
want to have some understanding of what's taking place. So I at least have some firm foundation of knowing what does this 10% rent growth actually mean. Like, sometimes when you just see the numbers in front of you, it gives you a better understanding. And then any type of claim that they're offering relative to operational superiority, whether it's increasing rents, decreasing
Sure.
expenses, or whatever, I want to have some proven track record that showcases that they've been able to deliver on those things in the past. Because what we know is everyone that's selling says your buyer can come in and increase rents and they can do this better than we did.
Yeah.
To which I would respond most cases, well, then why hasn't your operator just done that? Like, if it's easy to charge rents up 15%, why haven't you guys raised the rents 15%? Oh, we did it on
Absolutely.
10% of the units, and now you can extrapolate that. Maybe,
Right.
maybe not. Like, maybe you did it on the 10 best or 10% best of units in the complex, and the other side of the complex is hard to access, or it has not as good a visibility at nighttime, or it's farther from the mailbox. There's other things that create challenges. Just
Sure.
having a nuanced understanding of that. So I think, those would be some highlights. I think the main thing, though, is just educate yourself. Like, don't rely on somebody else to give you an education in commercial real estate. Take it upon yourself to get a working knowledge. You don't have to be a practitioner. You don't have to be a modeling expert. But if you can be somebody that understands, like, we're in a very jargon heavy industry, it's very easy to kind of get lulled into, well, they said the EGI is this, or they said, whatever. Have a working knowledge of what those terms mean so that you can actually understand when someone's telling you they expect to reduce, recurring expenses by X or fixed expenses by Y, like
Yeah.
what that actually means for you as a passive investor.
And then that ties really nicely to the next question. And other than maybe signing up for your course at Texas Tech, what would be some good educational resources for them to really dig in and start to learn some of this on their own? If you
Yes.
have any, you can share it.
Yeah, we have. Yeah, there's several options. I mean, like, so I would say right now in 2024, there's never been a better time to be an investor in the sense that resources are abundantly available. If you want to invest in real estate, or you want to invest in anything, you can get online, you can find a class, you can find something that can help you get educated. So at Trepp, we actually offer a training certification course. So if you want to understand valuation, you want to understand CMBS, you want to understand the mortgage side of the equation, we have a training course that you can sign up for. There's a company called CRE Analyst that does a very similar type of training course. There's Adventures in Commercial Real Estate. Those guys do a great job, and their website has a bunch of free stuff. As I mentioned, our website has a bunch of free stuff, even as basic as like Khan Academy, which is usually synonymous with like grade level type of education. They have some really great videos on commercial mortgage-backed security and underwriting and analysis. Like, no shortage of ways for you to get an education at a nominal cost that could pay some really big dividends.
Actionable steps that the audience can take. And I'm going to check out your guys' certification course as well. Another thing I learned here. Very good.
Yeah, something we launched this last year, and it's been very positive for us, and it's something we're going to lean into. Like, I'm a professor teacher at heart. Like, I think
Sure.
Educating folks, especially when it comes to their money and making decisions, is something that we have an obligation to do. And so we're really leaning in at Trepp to trying to create a more easy, education type of format where our podcast was kind of phase one. We're talking to you every week. We're educating you on what we see from the market from our perspective with our data. This is kind of phase two where we have a formal class where you can sign up. It's like 12, 14 weeks. You can actually come in. It's every week. It's online. You have assignments. You have a professor. It's like a legitimate certification course. The next phase will be taking that plus like some live meet and greets and some other things, and maybe introducing you to some of our broader network so you can continue to grow in your knowledge of commercial real estate. So I love being where we're at. I think in 2024, there's no excuse to not grow your network, to not grow your understanding and knowledge base. There's so many resources and tools available, and we love being at least a small part of that for people.
Good. All right. And now just a couple of quick fun questions. So I'm not sure if you're a bucket list guy or not, but have you recently, or do you plan on checking any bucket list items off your list?
So I will tell you, I'm kind of boring when it comes to this kind of stuff because I just work like crazy. So in addition to teaching at Texas Tech, I also teach at a community college. And this semester,
tons of free time.
Yeah. Oh, I'm telling you, I'm teaching 3 classes on Saturdays. So like 9:30 a.m. to 6:30 p.m. I'm teaching. So, but I think one of the things I want to do is I want to go watch a baseball game in every stadium across the U.S. One of the benefits of my crazy travel schedule is I get to go to a bunch of different cities and I get to meet a bunch of different people. But in the last couple of years, I really got to see some cool games and some cool stadiums. So last year I got to see Red Sox and Yankees at Fenway. I got to sit on the Green Monster, really cool deal.
Nice.
I went to Arizona this year and got to watch. I'm a Texas Rangers fan. We were playing the Diamondbacks there, so those are just cool. So I would say for that, like maybe just to try to check all the stadiums off on the list. It's not something I'll do next year, but it's something I'm progressively working towards. So that's pretty cool.
I love it. My wife and I are doing the same thing, and I was going to invite you if you're ever in Arizona. Let's go grab a D-backs game. But we try to hit 2 or 3 or 4 a year, adding stickers to our little sticker book. So
yeah, it's cool. It's cheap entertainment that's fun, and it's good if I'm traveling with the kiddos or whatever. Everyone enjoys going to a baseball game, getting some cotton candy, eating some peanuts. That's a pretty cool thing.
And you spend some time in New York now too, I believe, right?
Yeah, so I'm in New York quite a bit, probably at least 1 or 2 weeks a month. And so I've got to go to a Yankees game, into a Mets game, into a Knicks game, trying to take it all in. Next year, I'm going to try to get to the U.S. Open, watch some tennis stuff, and just the energy in New York. I mean, even for a real estate guy, I mean, like every time I fly in, I see the skyline. And we have this incredible terrace at our office right in Rockefeller Center, and you can see the buildings. And it's one of those things where like you look at just where we're at today. I don't think we could recreate New York City if we were starting over today. No, I don't think we could build the buildings. I don't think we could create the density. I don't think we could do all the architectural stuff. I just don't think we could recreate it. It's one of those things that it's just a wonder of the world. Like it doesn't get, there's all the negative stuff about New York. They got big rats. It's kind of stinky sometimes, like all this stuff. But like from a CRE perspective, it's a one of one. And as soon as I fly in, the energy is infectious. I love it. So for a Texas guy, I love splitting time in New York. It's a really, really cool thing.
I couldn't agree with you more. My wife and I just absolutely love New York. So very good. All right. And final question. If you had $100,000 that you had to place in the next week or so, where would you place it? It couldn't go with one of your buddies. Let's say that.
Yeah. So I'm a multifamily guy at heart. I think multifamily is, that's where I understand. It's the easiest investment to understand the underlying fundamentals that drive value. So it's not difficult to find the locations where you have net in-migration, where you have good transportation, where you have good school districts, where you have easy access to roadways that get people to and from work, where there's retail shopping centers that are close by. I mean, for me, like all of the things that I want to use to help quantify the safety, security, kind of upside of an investment, very easy to do that with multifamily. I would say beyond that, maybe like this Class B infill industrial play is a really interesting concept for me because I do think that last mile distribution concept is only going to get stronger and stronger as these supply chains and logistics get better, more efficient. You're getting Amazon not delivered daily, but hourly in some cities. I think that's a really good play. So I would say one of those two options, but I'm pretty partial to the multifamily stuff. It's easy to understand. And generally speaking, people have to have a place to live, right? So it's where I'd probably put the money if I had to make a decision today.
Awesome. And that's why we invite you on the show, because you're the expert in the multifamily space. So I'm the same way. I hold 70% of my investable capital in multifamily syndications. So could not agree more. But Lonnie, this has been great. Thank you so much for coming on the show. I really do appreciate what you guys are doing over at Trepp. I get a tremendous amount of value out of it. I know all of your listeners do as well. But thank you so much for being on the show today.
Yeah, thanks, Randy. I appreciate it. Thanks for the kind words. And if any of your listeners want to reach out, again, they can find us on Trepp.com. I have a profile there. My contact info is there. I'm also on LinkedIn. We're happy to help however we can. But thanks for the opportunity to talk, and good luck on the continued growth of the show.
Awesome. Thanks so much, Lonnie. And to the audience, as always, thank you again for joining us today. We encourage you to continue your education journey in the passive investing space, but more importantly than just the education, we encourage you to make the decision to invest in your first passive investment. Both Lonnie and I are convinced that you will be very glad that you did, and just wish that you had started that much sooner. So thank you again for joining us today, and be sure to join us again next Thursday for another great episode. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.